presentation contains current opinions of Moe Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Moe's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Mo.
Hello everyone, and welcome to the Compak YouTube update for July the 18th, 2023. I'm Mo Ansari, President of Compak Asset Management and the Chief Investment Officer here at Compak. You can get all of this information simply by going to our daily update page, thecompak.com/media. That's at the bottom right there on the right-hand side. You see that, where you can go and just go log into that compak.com/media. You can listen to the daily podcast. You can get registered for upcoming events. Subscribe to the iTunes podcast, where every day, if you're not there when I do the live broadcast, it'll automatically go to your iPhone, and you can listen to it anytime you want to. You can also download the Market Minute, a weekly one-pager that I put out. And then, of course, when I put out a YouTube update, you will be notified. So simply go to compak.com/media to get all of this information. All of it is free. Let's talk about the markets. We'll talk a little bit about the Fed. Not as much talk about the Fed now as we were hearing last week and the week before, but we'll talk about that. What are the odds of interest rate increases later on this month? And what about interest rate increases after that? Talk about the market. We are at a new high since 45.54 today on the close, nearly 55. Take a look at the economy technical analysis, and I will do a webinar where you can register for it next month on August the 8th. You can go and register for that, and then we'll take a look at the week ahead. So let's start with the Fed, what the Fed is looking at, what the Fed is doing. Again, the possibility of an interest rate increase for the July meeting, it was 99, it's 97 today, but a very high percentage that they are going to raise interest rates from the current rate of 5 to 5.25 to 5.25 to 5.5% at the next meeting, which is set for July 26th. So end of this month. That is built into the market. The market knows that. But where we go from there, the probability was very high that the Fed was going to raise interest rates more in the September meeting and then the November meeting. Now that probability has come down to about 29% that the Fed is going to raise interest rates one more time between now and November. Why those probabilities have come down? It is because inflation numbers have come down. The last CPI number was lower than expected. As I've been saying for the last year and a half, I expect inflation when we hit that July number, July of 22 last year, 9.1%. I said that's the peak. And everybody was running around in circles saying, oh my God, inflation this and inflation that. I said this from here on we're going to roll over, and this is why. I talked about that in the webinars in a lot more detail. Now I think we're going to see inflation coming down, but it won't come down as quickly. But we are going to see the largest component for inflation is shelter, and rents are starting to come down, and that'll go through. Another large thing that is holding up inflation right now is transportation or airline tickets. I think that as people are done revenge travel or whatever travel you want to call it, that everybody did when we came out of COVID and the money was saved, that money has been spent. That travel has been done. I think things are going to slow down. Why? Because I think unemployment is going to start going up in the fall later on this year. That is something that I've talked about for the last year and a half. I've said, look, everybody has looked for a recession. We haven't seen one yet. And that's where we talk a little bit about that. We haven't seen that. But now I think as everybody's happy that there's no recession, which they were looking for and talking about for the last year and a half. Now they're saying no recession. Well, I think we are going to see a slowdown in the next few months. And as that slowdown brings back the unemployment a little bit back up, it'll put the fear of jobs into everybody out there. And when people get scared of jobs, that's when they close their wallets. That's why I think this surge we've seen in travel is going to come to an end. Treasury yields usually combine as the Fed expectations change. That's, as we've seen remaining higher for longer. I think that's the expectation now, that the Fed, I think, is going to remain higher for longer. We'll see what happens. Looking at the economy, job openings lower, job claims higher. That's what we're starting to see. These are the jobless claims right here. that we've seen come down, and they've sort of stabilized now. The jobless claims that came straight down after COVID, and now they've stabilized and starting to slowly start to go back up. Also, the number of job openings, you can see that they are coming basically to the downside. As job openings come down, unemployment starts to go up, or at least jobless claims start to go up, that people are filing for jobless claims. That means the job market is getting a little bit weaker. And as that unemployment starts to go up, that'll take the pressure off the Fed to continue to raise rates. And with inflation coming down, the economy is slowing, no reason to raise rates. Share relying on credit cards. You can see that this is June 2021 in red. This is June 22 in blue. And you can see that June 23, you can see that the reliance on credit card is going up. Anybody who, in all income groups, we're seeing the reliance of credit cards. And you can see here there's a very small increase. That means that people making less than $25,000, the credit cards are just about as high as they can be. So I think these increases are slowing down in credit card debt, but it's going up. And as I said, people were saying, look, as long as I have a job, I can put it on my card, spend the money. But now people are starting to realize, if I don't have a job, I might not have the money. So let me stop spending. I think that's going to be the next thing that we're going to see. I'm going to do a webinar on the 8th of next month. If you want to register, you can go and do that right now. Go to compak.com/seminars. You have to be registered. You have to have an access code. And I'll try to answer as many of your questions as I can, but you have to be at the webinar to attend. Looking at the technicals, again, 4637 is the next number I'm looking at as far as the S&P goes. Why 4637? That's the March 29th high that we made right here. And that's last year's March's high. That's the next resistance. Once we got above this 43 number here, once we filled this gap at 4200 that I talked about for months, 4300, now this is the next resistance, and we closed today at 4555. So we're only about 80 points away from this number. If we can get above that, now remember, this is a fifth wave high. Once we get to wave 5, then we start usually a pullback of A, B, C. Either it's A, B, C, or 5 waves to the downside. We could get a pullback from here. But are we going to get here first, 4637 first? Or the long-term target, when you project from this high, a Fibonacci projection, we get that to 4800 to 4923. Are we going to go straight up there? Or are we going to hit this, back off, and then come back later on this year? I think we'll have to wait and see. Again, let the market make the decision. I know a lot of people are sitting on their hands saying, oh my God, the market can't go up. The gloomers and doomers, now they're chasing this market. The sold out here at 3,800, the world was ending. Now they're buying at 4,500 saying, oh, it's left without me. Usually those people end up buying the highs, selling the lows. They snatch defeat from the jaws of victory. Somehow or the other, they manage to do that. It's just their emotional makeup that does that. They think they can trade the markets. They're caught in one trade. They get stuck in one stock. They sit there forever. But next 3 years later, it comes back. Oh, look, I'm back to even. Last 3 years, the market is up 25, 30%. Well, they missed that 30% had they had the diversified portfolio and sat with that. But no, they think somehow people can outsmart the market. It will not happen, folks. Stop kidding yourself. That's what too many people try and do. Long term, each one of these vertical lines is 1 week of trading. You can see 46.37, then 48.18 is the next number. Why? That is the all-time high that we made at the beginning of last year. And if we can get above that, we get a projection from here, Fibonacci projection, 5,000 to 5150. Now this is a weekly chart, obviously going back number of years. This goes back to 2020, going back about 3 years. So it doesn't mean that we're going to go straight up. I think we can go here, come back here, then go back up again. Could be a year from now. Could be next year that we hit 5,000. But those are the long-term targets that we're looking at. On the downside, we have support at 4,200. If we get below 4,200, party is over. We're going for a pullback or major correction. I don't expect that, but you never know. And then we've got 40.50 as the 50-week number there. NASDAQ on the dailies, we're looking at again this number right here, which is 14,650. We are at 14,300. 64. That's where we are right now, though we are very close to the March 29th high of last year. So that's going to be the next resistance on the daily chart. Support is somewhere around 13,005, 13,002 is what I'm looking at on the downside. On the weekly charts, 15,800. That's the all-time high that we made in the NASDAQ in December of 2021, beginning of 22, really is when the markets peaked out. But we're looking at, I didn't do a projection from here yet. I will do that, where that Fibonacci projection comes in. That year's away, so we'll have to wait and see. Interest rates, I was looking at this 4.09 high as resistance. We came to it last week. We fell back up and down from there. We're now back to 3.8. So as long as we're between here and here, we're just going back and forth in these charts right here and right here, about 4% on the upside, 3.25 on the downside. As long as we don't break below 3.25, if we do, that means the Fed is bringing rates down. Rates are dropping. Why would rates drop? Economy is dropping. We don't want that to happen, because that would be a much deeper recession that we're looking at. Gold had a good day today. It broke above the 50-day moving average, which is 1967, closed at 1982. Gold is going up because the dollar is coming down, and as the dollar comes down, that's giving gold a little bit of a boost, because interest rates are backing off now with the economy slowing. But in the long term, a slower economy, lower inflation is not good for the gold market. So yes, short term it might give it a boost, but long term, a slowing economy globally, especially with the GDP numbers we got yesterday out of China, showing that the global economies are slowing. We're still doing okay, hanging in there here in the United States. But look at China. They did not get the COVID, the reopening bump that everybody expected. Europe is already in a recession. How are these knock-on effects going to affect our economy? I'll talk about that a lot more at the seminar and visit that. In the week ahead, I think big earnings are going to be what's going to drive the markets. Earnings were expected to be down 6%. Now the expectation is that we could be down 9%. I think that's overdone. Earnings are going to come out better than expected. We've seen those in the financials, and that's what I think is going to drive the market for the next week. Those are my views. Those are my thoughts. Thank you for joining us. You've been listening to the YouTube update and watching the YouTube update. I will be back with you in the next couple of weeks. Make sure you subscribe to this channel so whenever I post an update, you'll get notified. Thank you again.
This presentation contains the current views and opinions of Moise Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compak Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that overfocus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors, because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.